Previously, we had started with the 5th unit and we were talking about the retirement of the partner. And under the retirement of a partner, we saw those different adjustments that are to be made in case of retirement. We had seen a few adjustments with regards to the goodwill. We saw 4 cases and we also saw we solved a few problems under that. And we also saw the different adjustments to be made with regards to revaluation of assets and liabilities. And we saw how that in case of revaluation of assets and liabilities, we can revalue the assets and liabilities by preparation of the revaluation account or the memorandum revaluation account, depending upon the situation and the demands of the questions as well. And we saw that in case of revaluation, it's basically the same just like how we have seen in case of the admission. Okay, so we're just going to be solving additional problems with regards to all of these to just understand the concept a little better. So look at the question here, question number 6. A partnership consists of 3 partners with capital sharing profits and drawings as follows. So in the question, you have been given partners A, B, and C, and the capital for partner A, 1,50,000, capital for B, 1 lakh, and for C, rupees 50,000. And profit, they've given it to you as a percentage, 50%, 30%, and 20%. If you had to show it in terms of the profit sharing ratio, it would be 5:3:2, right? Okay. And then when it comes to drawings also, they've given it to you for each partner separately. Drawings of A, rupees 15,000, drawings of B, rupees 10,000, and drawings of C, rupees 5,000. So additionally, they have given to you capital is chargeable with 5% interest per annum, and then B and C each receive a salary of rupees 7,500 per annum. Capital will be remaining fixed. So if the capital remains fixed, it means that all the changes we have to make will be through your partner's current account, right? Okay. And then A had loaned a further rupees 1 lakh to the partnership at the rate of 4% per annum. Profit for the year before charging partners' salaries, interest on loan, and capital was rupees 1 lakh. Now A retired at the end of the year and B and C, in accordance with agreement, take over his share. Total goodwill is valued at rupees 1,25,000 and fixed assets are revalued upwards by rupees 25,000. So they've asked us to prepare the profit and loss appropriation account, partner's current account, and also determine the amount due to A, wherein you don't have to prepare any account for A. Okay, there is no account that will be required. So firstly, before we dive into the question, let's just look into what we should do, what falls where. Okay. So as I said earlier, prepare profit and loss appropriation account and partner's current account. So first point, capital is chargeable with 5% interest per annum. So capital is chargeable with 5% interest per annum. How do you pay interest? You're going to be paying it out of the profits, isn't it? So it should affect your profit and loss appropriation account. At the same time, it is on capital. So it is an interest on capital, therefore it should affect your partner's current account as well. And then point number 2, B and C each receive a salary of 7,500 per annum. And the salary is paid by the firm. If it's paid by the firm, then it's going to go out of the income of the firm, isn't it? So it is going to affect the profit and loss appropriation account. At the same time, the people who are receiving it are the partners, so it should also affect the partner's current account. And then moving on, point number 3, A had loaned a further rupees 1 lakh to the partnership at 4% interest per annum. A had loaned an amount which is rupees 1 lakh, and this amount of rupees 1 lakh will affect the capital account of the partners, not your current account. Okay, and the partnership, that amount interest is to be charged out of that loan. So the interest on the loan should be deducted from the net profit. So that amount should affect your profit and loss appropriation account. And then you have point number 4. Profit for the year before charging partners' salaries, interest on loan, and capital was rupees 1 lakh. So profit for the year, obviously, it should go to your profit and loss appropriation account. And then point number 5, A retired at the end of the year and B and C, in accordance with agreement, take over his share. Total goodwill is valued at rupees 1,25,000. Goodwill will not be affected in case of the profit and loss appropriation account, neither will it affect your partner's current account. And then you have fixed assets revalued upwards by rupees 25,000. We are not preparing the revaluation account, so this will not affect any of your other accounts. So they've told us prepare the profit and loss appropriation and the partner's current account, and also to determine amount due to A. So we have already analyzed the question and we know which will fall where. Okay, we know what will fall under the profit and loss appropriation and what will fall under your partner's current accounts. Okay, so let's start with the preparation of these accounts. So open the profit and loss appropriation account, profit and loss appropriation account for the year ended so and so. So you have prepared the T-shape account, particulars rupees, debit, credit, and so on. Okay, prepare the entire account. All right, so for profit and loss appropriation account, firstly, you have to check if there is any profit. And we've already seen the question. There is point number 4. Okay, point number 4 is given profit for the year before charging partners' salaries, interest and loan and capital was rupees 1 lakh. So before we make any of the other changes to profit and loss appropriation, let us first record the profit. So by net profit, now net profit is given to you as rupees 1 lakh. But remember, A had loaned an amount and on that amount there is 4% interest that is to be paid. Okay, so that amount of interest, let us deduct that first. Now either you can write it as by net profit and then you can deduct the amount of interest later through in the amount itself, or you can deduct it in on the debit side of your profit and loss appropriation account. So let's deduct it along with the net profit. So net profit rupees 1 lakh minus 4% per annum interest on the loan provided by A to the firm. So 4% of rupees 1 lakh will come to rupees 4,000. 4% of rupees 1 lakh is rupees 4,000. And this 4,000, remember, it is your 4% interest. So 1 lakh minus rupees 4,000 will give us rupees 96,000. All right, so now we have the opening balance of net profit. Now let's make the adjustments for which we are going to require the profit amount. Okay, so firstly, point number 1, capital is chargeable with 5% interest per annum. So interest is going to be deducted from the net profits. So to interest on capital, or you can write it as to partner's current account, and under that you can write interest on capital. So to interest on capital account. So interest is going to be for all of your partners A, B, C. Interest is chargeable at 5%. And the capital is being given in the question. If you look at the table, the second column, capital for partner A, 1,50,000, for partner B, 1 lakh, and for C, rupees 50,000. So 1,50,000 for partner A at the rate of 5%. So interest comes to rupees 7,500. Similarly, in case of partner B also, the capital is rupees 1 lakh. Interest at the rate of 5% comes to rupees 5,000. And then for partner C, the capital is rupees 50,000. Interest of 5%, it should be rupees 2,500. And we can move these amounts to the outer column now, rupees 15,000. Okay, so first point is completed in case of profit and loss appropriation. Now let's look at the second point. B and C each receive a salary of rupees 7,500 per annum. And they are receiving a salary. Salary also is going to be paid by the firm, and the firm can pay salary only through the net income or the net profit. Okay, so this will also affect our profit and loss appropriation account. So it'll be, you can write it as, again, to partners' current account, and in the bracket you can write to partners' salaries, or you can just write it simply this way also, to partners' salaries account. To partners' salaries account, and you are giving salary only to two partners, B and C. B, C. And they're getting salary of rupees 7,500 each person. So bring the total to the outer column, rupees 15,000. Okay, now is there anything else? Just look at the question once again, see if there's anything else that affects the profit and loss payment. Okay, point number 1 is done. Point number 2 is done. Point number 3, we've already recorded that 4% interest. Point number 4 also we've recorded. Point number 5 does not affect the profit and loss appropriation account. Okay, so now let's close down the profit and loss appropriation account then, because there is nothing else that affects this account. So we can now close down this account. The total, get the total, should come to rupees 96,000. And now we're going to get a profit. So you can write it again to partners' current accounts profits, or you can just write it as to share of profits. To share of profits. And profits will be shared amongst all of your three partners, A, B, C. So calculate the total amount of profit, 96,000 minus 15,000 minus 15,000. Total amount of profit is rupees 66,000. So divide the 66,000 amongst A, B, and C. In order to divide, as we've said, you can take the profit sharing ratio, or it's already been given simply in the question, profit percentage. So the total profit, whatever is earned, A will be getting 50% of that, B is getting 30% of that, and C is getting 20%. So divide the 66,000 amongst your three partners based on their profit percentage. A is receiving 50%, so 66,000 into 50% is 33,000 rupees. And then in case of B, it will be 66,000 into 30% will be 19,800. And finally for C also, 66,000 into 20% will be 13,200. Okay, so we have also done the division of the share of profits. So this is the profit and loss appropriation account. Next, they've asked us also to prepare the partners' current accounts. So let's start with the preparation of the partners' current account. So we've prepared the partners' current accounts, prepared particulars, and then your partners A, B, and C, particulars A, B, and C in the debit and credit columns. Okay, so in case of partners' current account, because this is not the partners' capital account. If it was the partners' capital account, we have started with the opening balance, and then after that we would have a closing balance of your partner's capital account. But under this situation, we will not have a current account balance if it's not mentioned in the question. In the question, they have only given us capital account. They have not mentioned to us a current account, so we cannot use this capital account balance to record in the partner's current account. Okay, so we just have to record all of those changes that we've made with regards to your partner's account. So we can see these changes when it comes to your profit and loss appropriation account. So let's just glance at the profit and loss appropriation account. Here you have partners, on the debit side you have interest on capital account. So A, B, and C, that means this will affect your current account, right? And then partners' salaries also, it will affect your partner's current account. And then share of profits also, because it's transferred to your partners, it will also affect your current account. So from the profit and loss appropriation account, we already have three entries which we should record in your partner's current account. From the profit and loss appropriation account, we have three entries to record in the current account. So let's record these entries one by one. Let us start with the interest on capital. So in the profit and loss appropriation account, you have interest on capital for all of your three partners. Let's record that here by interest on capital. So by interest on capital, for partner A, it is rupees 7,500. For partner B, it is rupees 5,000. And for partner C, it was given as rupees 2,500. And the next item in the profit and loss appropriation account is your partner's salaries. So let's write that also down by partners' salaries. By partners' salaries, A is not receiving any salary, B and C are receiving equal amounts of salary, rupees 7,500 each. And the last detail in case of your profit and loss appropriation account, the last transaction is your share of profits. So let's write that by share of profits, by share of profits. A, B, and C, rupees 33,000, and then rupees 19,800, and rupees 13,200, which you've calculated already based upon the profit sharing ratio. Now, what else is there that affects your partner's current account? Let's come back to the question. Okay, go back to the table. In case of the table, first column is just the name of the partner, second column capital, which is not affecting the current account, third column profit percentage, which we've seen and will keep in mind, and then you have drawings. Drawings also affects the current account of your partners, okay? It'll come out of the capital of your partners, right? The drawings, they can withdraw money from the capital account, so it'll affect your partner's current account. So let's write that to drawings account, they've given amount for A 15,000, for B 10,000, and for C rupees 5,000. All right, okay, then let's see what else is there. Okay, let's look at the adjustments now. Point number 1, capital chargeable, 5% interest per annum, done. Interest in capital, we've recorded. And then next point, B and C each receive a salary of 7,500. That is also done. We've recorded partners' salaries. And then A had loaned an amount of rupees 1 lakh. That will affect your capital account. And then you have profit for the year. That also we have recorded, profit and loss appropriation account. And then point number 5, A retired, and then total goodwill is valued at 1,25,000 and fixed assets are revalued upwards by 25,000. That also doesn't affect partner's current account. And point number 6 just tells us to prepare things. So we have come to the end of the partner's current account. Let us close the partner's current account and check what the total of the debit and credit side comes to and what is the balancing figure. Okay, so total should come on your credit side rupees 40,500, then rupees 32,300 and rupees 23,200. Okay, this is our total for both sides. That means on the debit side we'll be having a balance for your accounts of your partners. All right, so let's record the balances now. To balance, closing down, carried down. A is the retiring partner. A will not be receiving any amount in the form of balance. Instead, we have to close his account by preparation of another account known as our loan account. So to A's loan account. Any balance for A will be transferred to his loan account. Now let's see what is the balance for A. 40,500 minus 15,000. A's loan account is rupees 25,500. As stated, A's loan account will only be for A, right? So B and C, nil amount. Okay, now let's see the balances for B and C. For B, balance is 32,300 minus 10,000. It will give us rupees 22,300. And for C, 23,200 minus 5,000, it comes to rupees 13,200. Sorry, it should come to rupees 18,200. Okay, so now we have the balances. We also know all the details with regards to your retiring partner. And in the question, they've told us prepare profit and loss appropriation account. We've done that. Partner's current account, that is also done. Now they've told us to also determine the amount due to A. No loan account is required. So when they're saying that we have to prepare the amount due to A where there's no account required, we should not open the loan account for A. Rather, we should just have to prepare a statement format. So let's open a statement, calculation of amount due to A. I've prepared a statement in the form of a table. So particulars and rupees, 2 columns. So in case of amount due to A, when a partner is retiring, we have to pay him everything that he has brought into the firm, and any interest or any interest on the capital, any interest on drawings, all of those should be adjusted to his capital amount. Okay. So we have to start with the opening balance that he's having in case of his capital, and then if we had prepared the capital account, then the current account balance would have also been shown in the capital account, right? So that also should be included when we're calculating the amount due to A. And then he has also given an amount of loan to the firm. That amount of loan also is due to him, right? He has to receive back the amount, and on that loan he is supposed to be receiving some amount of interest. That interest is also due to the retiring partner, to partner A. And then additionally, point number 5, we have not touched goodwill and the fixed assets, the revaluation. So when a partner is retiring, you remember we had calculated the goodwill also. It had to be distributed to your retiring partner. So the goodwill amount also, we have to calculate his share in the amount of goodwill and we have to give that to the retiring partner. Now, in case of fixed assets revaluation, point number 5, fixed assets revalued upwards. So there is a revaluation and revaluation is an increase. So if it's an increase, that is also recorded or added to the amount due to A. Okay, so let us now prepare this amount here. So firstly, as I've said, capital account. So capital account balance, capital account balance. In the question, it is given to you as the table. Okay, as per the table, partner A's capital is rupees 1,50,000. So under the amount column, rupees 1,50,000. And after that, we also said the current account balance also should be recorded. So current account balance is as per the partner's current accounts. You've given A's loan account. Okay, he doesn't have a balance, but he has a loan account, and this is an amount due to A, right, from after calculation in the current account. So current account balance is rupees 25,500. Okay, and then he gave a loan, point number 3, he gave a loan to the partnership, which should be received back. So loan account balance as well, loan account balance of rupees 1 lakh. He has a loan of rupees 1 lakh. And on that loan, there is an interest which is due to him. The other interest has already been charged to the profit and loss appropriation account. We have adjusted it through the partner's current account, and that is how we came to the current account balance. Now, this other interest, it should affect the amount due to A. So it should be an accrued interest. It hasn't been paid yet. So interest accrued on loan, accrued interest on loan, accrued interest on loan. So the interest accrued is at the rate of 4%, as we have already seen, and it comes to rupees 4,000. Okay, and as we've stated earlier, there is a share of goodwill, point number 5. Total goodwill is 1,25,000. Out of that total, some portion of it belongs to A. So that portion which belongs to A, we have to pay to A. So write it down as share of goodwill. Share of goodwill. So total goodwill is rupees 1,25,000. And how much will A be getting? The third column, profit percentage, is 50%. So he'll be getting share of goodwill in his profit sharing ratio, so which comes to 50%. So 50% of 1,25,000 is rupees 62,500. Fine. And finally, on the point number 5, we haven't recorded yet is only fixed assets. In case of fixed assets, they were revalued upwards by rupees 25,000. Revalued upwards means there is an increase in the value of assets by rupees 25,000. The change in value is equal to rupees 25,000. And because there is, in case of revaluation, if you remember, the profits on revaluation or the loss in revaluation, we often distributed it amongst the partners in the old profit sharing ratio, right? So in this situation also, the fixed assets, after they have been revalued, we have to distribute it amongst all of your 3 partners in their profit sharing ratio. Okay, so here, fixed assets are revalued upwards. Because they are revalued upwards, it means there is an increase in the value of assets. So it is a profit, right? Imagine there is an asset worth ₹10 rupees. Okay, original value is 10 rupees, but now it's been revalued and it's come to ₹20 rupees. Okay, it's come to 20 rupees. That means that increase in value from the old value to the new value, that 10 rupees difference is there, that is a profit to you, correct? So here also fixed assets, because they're revalued upwards, there is an appreciation of the assets. It leads to a profit of rupees 25,000, which should be distributed amongst your partners in the profit sharing ratio. So let's distribute it for partner A. It'll be as revaluation profit. Revaluation profit. So the assets are worth rupees 25,000, and out of this 25,000, 50% of the total share belongs to A. So he'll be getting 50% of 25,000, which is rupees 12,500. So once more, just go through your question once again. See if you've missed anything at all. If you've missed anything, where it relates to. Okay, so we've seen that we have recorded everything. So now let us close this statement. Close the statement, add all of these amounts. It should come to a total of rupees 3,54,500. Okay, this amount of rupees 3,54,500 is the final amount that is due to A, okay, or the amount to be paid to A on account of his retirement. Fine, so this is how we solve question number 6.